I'd like to thank everybody for joining me today. Today, I want to talk about the power of life insurance, and more in particular, talk about life insurance as a planning tool, just not a product. I think a lot of the public out there thinks that life insurance is just a death benefit, but it's a planning tool that can help protect, it can accumulate and create options to help in the planning process going forward. So if you start looking at it, the question most people think about life insurance, what happens if I die? But if we look at it and say, what can this policy help me do while I'm living? It changes the whole conversation because that shift now takes it from just a product that provides a death benefit to the planning tool that it can become. And if you think about it, life insurance has evolved, and it's evolved because of cost, um, providing more guarantees, flexibility in premium, increasing options on how to grow the cash value, and having access. And then we'll talk about some of the new riders as well. A lot of people in the public think that life insurance is just a term product. Term is a great product for those that need it. It's like renting a death benefit. I'm going to have a death benefit for 10, 20, 30 years. And after that period of time, that low premium cost goes away. And you either have to keep paying a higher premium, get rid of the policy, or do something else. Then we have whole life. Whole life is a type of policy that provides a lot of guarantee, can create cash value. It's a little bit of an older design in the fact that you can't, change a lot of things inside the product, but it's a good product for those that just want to buy something that's going to grow. And as long as you make the premium payments, will look a lot like what you've purchased. Along came universal life. The problem with whole life is you were kind of locked in on the premiums. Universal life allowed the policy to be designed with more flexible premiums. They're again helping and meeting some of the clients' desires in what the product can do. Then it was we want more ways to just grow the cash value in there. Whole life was tied to the what the insurance company provided as their interest rate. Universal life was tied to what the company provided as the interest rate. Variable life and now index life allow the policy to either be directly invested into the market, or index life will follow indexes but won't be directly invested in the market. So there again, growth. Finally, we have the riders, and that provides those more living benefits to take care of the insured now versus waiting till there's a death benefit to pay out. When you look at the policy design, this is where we get to look at what is there that this policy is going to provide. Of course, every life insurance policy is going to have a death benefit. Now, that death benefit is designed for protection. It's going to protect the family, protect a business, provide estate liquidity. We're just getting that death benefit in place because we need that if somebody passes away, the insured passes away, they're leaving a hole in their planning that needs to be filled. Maybe the family needs to, the breadwinner passes away. We need to provide that income to take care of the family for the rest of their lives. So always look at what are we trying to protect, and that's what we design the death benefit for. Next, we can have accumulation. We can grow that tax deferred cash value inside the policy. There again, think about whole life is going to grow at a fixed interest rate. Universal life will have a fixed interest rate. If you want to really try and hit the home run, you can go into variable life and invest directly into market. Or you can be in an indexed where you're going to have floors, so you can't go typically below zero, but you may have a cap that limits the growth in the higher earning higher indexed years. So there again, every client's going to be different in what they want and what they want their policy to do. Finally, there's going to be access. Well, for growing this tax deferred cash value within the policy, Now you can access this either through withdrawals or policy loans or some combination of those. So most policies allow you to make those choices in the future when you're going to need access to that money. But design is the priority here. Now, if we look at the core benefits of life insurance, now I have in here core benefits with the right guardrails on it. So if we're looking at the right, trying to design this policy, we want to make sure that we do this the right way so we get the right tax effect and the right tax advantage design. The death benefit of a life insurance policy is generally income tax free. Now that can be changed by improper design or sometimes proper design, but it's going to be income tax free. And we can go to the next step. If we needed estate tax free, it's not the design of the insurance policy. We have to do some additional planning to make sure that works. The cash value is going to grow tax deferred, which means it's not going to be taxed on an annual basis like a money market account or other types of investments. When you want to access the money, if the policy has been designed properly, you can take withdrawals up to the basis in the policy, or you can take loans if they're available in the policy. If you have enough cash value, you can continue to take loans until you hit the ceiling. But that access, if done right, can be tax free so that you can always have access to that money when you want, how you want, and do it tax free. The nice thing about the life insurance, there's with a qualified account, IRAs, if you take money out before age 59 and a half, you're going to have the tax plus a 10% penalty. We don't have that problem with the life insurance policy. As long as there's cash available, you can access it when you need to. Finally, there's premium flexibility. How do you want to fund the policy? What type of premium payments do you want to make? How long do you want to make premium payments? That's in the design that the client's going to have to, figure what's best for them. And finally, we have living benefits. These are ways to accelerate the death benefit of the policy to cover terminal illness, long-term care, chronic illness. All of these benefits are allowing the insurance companies designing the policy so you can use these for the what if events that may happen in the future. So if you look at this, how these riders, will work. First, we're going to have a terminal illness benefit. Typically, if you are at a point in life where, let's just say cancer, where you have less than a year to live, most of them are 12 months, that death benefit can be accelerated so that you can take care of those life-changing needs now versus waiting for the death benefit. Typically, that's going to be a little bit of a reduction in payout versus the death benefit, but it allows you to use the policy because this health condition that is going to terminate life, early, accelerate that benefit, cover the things now. Chronic illness, and I'll go ahead and show long-term care. These are similar benefits if you have a long-term care need. And the policy can either be built with a chronic illness rider. The chronic illness rider typically has the same triggers as a long-term care benefit, but you don't pay for that benefit in upfront in the policy. You only pay for it if you access that benefit. So there will be a charge on the back end when you access for chronic illness. If you put a long-term care rider into the policy, there's going to be a charge for that up front. So as you're making premium payments, part of that premium payment is going to go to pay for that long-term care rider. There again, now when you take and access those benefits for long-term care, you're doing it without any additional charge off the back end, but allows you to look at it and say, this policy is going to help me, with the death benefit if I pass. If I need this for terminal illness, chronic illness, or long-term care, it's there. And of course, we've got the access to the cash value if you're building for cash value. So the life insurance policy, the design is crucial. What are we trying to solve for? And as we look through these, The policy can be designed. It's not a product as much as it is a tool that allows us options to plan. So start with the planning objective, match the design to that objective, and make sure you're reviewing that on a regular basis to make sure the policy's performing and doing everything you want it to do. So I appreciate everybody getting on. If you have questions, reach out. If not, we'll talk again next week. Thank you.